Good morning, friends. So today we will be starting with a new As13, that is accounting for investments. Again one of the very simple As. You have to understand basics first and then we will go to illustrations. So accounting for investments basically deals with how to account for investments other than immovable properties, because accounting for properties are dealt with As10. So other than that, whatever investments you are making, primarily you can say in shares and securities, or it might be somewhat like gold, silver, or some other valuables. So if you are making an investments, how to account for such investments in your books of accounts will be discussed by As13. So As13 standard deals with the accounting for investments in the financial statements of enterprises and whatever disclosure requirements are there. Now this standard doesn't apply to certain assets. Let us discuss that. The first, this standard doesn't discuss about the revenue generated from these investments like interest, dividend or rent. Now this will be covered by As9, revenue recognition. Operating or financial leases are not covered here because again there is a separate As for leases. Investments on retirement benefit plans and life insurance enterprises. So all your retirement benefit plans or insurance businesses policies are covered by their own insurance IRDA and their own act. And then mutual funds, venture capital funds and or related asset management companies, bank and public financial institutions formed under a central or state government act or so declared under the Companies Act. Now they have their own accounting terminologies, accounting methods. So As doesn't apply to such mutual funds or banks or venture capital funds. So barring this, all other cases As13 is applicable, and as I've already told you, As13 doesn't apply for investments in immovable property because As10 is going to deal with that. Now in some cases investments are held as stock in trade, or rather than investments I should say shares and securities are held as stock in trade. Now that will be not again governed by this because this applies only if it is held as investments. So investments, let us go to definition now, are assets held by an enterprise for earning income. So the primary objective is to earn income either by way of dividend, interest or rent, or it might be for capital appreciation. Let us say to hold it for a longer period, so there is a capital appreciation, you earn it and there will be profit from that, or for other benefits to the investing enterprise, or it might be any other benefit what they might have kept in their mind. Now assets held as stock in trade are not to be treated as investment, so this As doesn't apply to such stock in trade items. Now we need to understand two parts first of all before we go ahead, that normally the asset investments will be held or will be recorded in your books or will be carried in your books at cost or fair market value. It will depend upon these two things. So we need to understand what is fair market value, and that is fair value basically, and we also need to understand what is cost. So let us try to understand these two terminologies, cost and fair value. So first of all, fair value. Fair value is the amount for which an asset could be exchanged. So the amount at which you can give that asset and you can earn money, but between a knowledgeable willing buyer and knowledgeable willing seller. So there should be both knowledgeable buyer and seller and they are willing to exchange that asset in at arm's length transaction. That is, there is no relation between them, there is no pressure, there is no certain other undue influence in that transaction. Under appropriate circumstances, market value or net realizable value provides an evidence of fair value. Means you can treat market value or net realizable value as good as fair value, but then there should be at arm's length transaction, there should not be undue influence, there should be willing buyer, willing seller, both should be knowledgeable. So in simple words, you can say it's a fair market value. That is the amount you can fetch by selling that investment in open market at arm's length price. What is related to that, let us try to understand what is market value. So market value is the amount obtainable from the sale of investment in an open market. If you sell it, what amount you'll get less net of expenses. That is, whatever expenses required you have to reduce from that, net amount would be fair market value. Net of expenses necessarily to be incurred on or before the disposal. Now very important part we are moving to, that is whatever investments you are holding, you have to first of all bifurcate it as current investment or a long-term investment. Now it's something odd, current and long term. You don't say current or non-current, or you don't say short term or long term. You have to say current or long term. Now what is current investment? So current investment, there are two things you have to properly classify, or you have to fulfill two conditions. The first is, it is that investment which is readily realizable. So if you decide to realize it, it should be readily possible. And second is intended to be held. That intended word is important. To be held for not more than 1 year from the date on which investment is made. So the day you are making that investment, your intention is to not hold for more than 12 months. Please understand intention. Actually, let us say your intention when you buy that was not to hold for more than 12 months, but you hold it for 15 months. Will it be still a current investment? Answer is yes. Because on the date of purchase, your intention was not to hold for more than 12 months, but later on, due to some reason, you have hold it for more than 12 months. Will it be still treated as a current investment? Answer is yes. So you have to see the intention on the date of purchase. So the intention to hold for not more than 1 year is to be judged at the time of purchase of investment. So when you purchase it, what was your intention? To hold it for 8 months. It is a current investment, even if you hold it for 13 months. So there are two things basically. It is easily realizable and your intention is to not hold for more than 12 months. In that case, that asset will be called as a current investment. Now what is long-term investment? Very simple. That investment which is not a current investment is long-term. That is, first, either it is not readily realizable or your intention is to hold for more than 12 months. Now again understand here. When you bought that asset, your intention was to hold for 5 years. But you sold it after 6 months. Can it be still treated as long term? Answer is yes. Because on the date of purchase, your intention was to hold for more than 12 months. Then it will be classified as a long term. Please understand, your actual period of holding is not relevant. What is relevant is your intention to hold. Now, once you classify the asset as current investment or long term investment, how to recognize will depend upon that. Now that is a later point, but it is related to this. I'll cover it immediately. Very important. Second, very important. First is current and long term you have understood. Now let us talk about recognition. Now for your current investment, that investment will be valued at each balance sheet date at cost or fair value, whichever is lower. So at every balance sheet date you have to check whether what is your fair value. So at cost or fair value, whichever is lower, you are going to take that. Let us say your fair value is less than cost. Then whatever is the reduction in value will be charged to your profit and loss account. It will go to your P&L account. Let us say in next year your fair value increases. Then it cannot go beyond cost, but whatever increase is there, that will go to your P&L account as your income. Let us talk in example. Let us say in the first year, we are talking about current investment only. You are holding current investment. For first year, cost is, let us say, 10 lakhs and fair value is 12 lakhs. So you are going to take whichever is lower, that is 10 lakhs. And there is no reduction in value, so there nothing will go to P&L account. Let us say in second year, the cost obviously remains 10 lakh and now the fair value is 8 lakh rupees. Now you are going to take 8 lakh as your carrying amount. And 2 lakhs will be charged to P&L account as your expenditure. Now let us say in third year, now the carrying amount is 8 lakh, don't forget that. Your cost is 10 lakhs and now your fair value is 9 lakh. Now what will happen? In that particular case, you are going to take, now instead of 8 lakh, you are going to take it at 9 lakh as your carrying amount and 1 lakh will be treated as your income transferred to P&L account. Let us say in fourth year, obviously your cost continues to be 10 lakhs and your fair value is 12 lakhs. Now what you will take? You will take 10 lakhs as your carrying amount and 1 lakh will be transferred to your income again. Now let us say in fifth year, your cost is 10 lakhs and your fair value goes down to 7 lakh. You will take it at 7 lakh and again 3 lakh will be transferred as an expenditure to P&L. I hope everyone understanding what to be done with current investment. Yes, everyone understood that you have to take it at cost or fair value, whichever is lower. And when your fair value is lower than cost, whatever is the difference will go to P&L as your expenditure. In later on, if your fair value increases to the extent of cost, it will go to your income. Obviously, it cannot go beyond your cost because you have to take whichever is lower. Now talking about your long-term investments. Now for long-term investments, the recognition criteria or the carrying amount is very clear. It has to be compulsorily at cost. No other option. You have to take it at cost. Even if your fair value is less than cost, you have to continue to take it at cost. However, it has one clause which says if there is a permanent damage or a permanent loss in the value of investment. Let us say you have bought the asset at 10 lakhs. Your fair value keeps on changing, 8 lakhs, 9 lakhs, 11 lakhs, 10 lakhs. Fine, you will continue to take it at 10 lakhs. But over a period of time, there is a permanent loss. That is, let us say 2 lakhs of your worth of investment is permanently lost. You know, you are sure that it cannot be recovered. That is, your amount recovered cannot be more than 8 lakhs. You are very sure about it. So 2 lakhs, if there is a permanent loss, then this should be transferred to P&L as expenditure, and you have to carry it at 8 lakhs over a next period of time. Now, let us say after doing so, in future years, the reason for such permanent loss is gone, or there is a significant improvement and the value has increased, then you can again bring it up to 10 lakhs, and these 2 lakhs will be treated as your income transferred to P&L account. So I hope you have understood the accounting or carrying amount of long-term investment also. So let us discuss very quickly. For long-term investments, you have to compulsorily take it at cost. Fair value is not to be considered. But if there is a permanent loss in the value of investment, now whatever is the extent of permanent loss will be written off to P&L as expenditure, and your carrying amount will be reduced to that extent. In future years, let us say the reasons for that permanent loss has gone, or there is a significant improvement and the value has increased, then you can again take it back to cost, but not more than cost, and that extra amount added there will be treated as your income transferred to P&L account. So that was related to your recognition. So that further point we have covered. So two important points covered: how to classify long term and current, we have understood, and the second, how it has to be recognized: current at cost or fair value, which is lower; long term at cost but permanent loss to be considered. Now we have understood what is fair value, but we have not understood what is cost of investment. Let us try to understand what all things will be covered, what are the specific scenarios. Now one thing I want to point out here, while solving sums on investment chapter, you have already covered all these points, so I'll quickly go through it. That is, what about cum dividend, ex dividend, cum interest and ex interest? What if it is a pre-acquisition period dividend? What about right shares? Now all these transactions we have covered in sums, so here we will concentrate very quickly on theoretical part only. I will not be go in much detail in your examples, considering that we have already solved those sums. Let us try to understand one by one cost of investment. The cost of investment includes acquisition charges such as brokerage fees and duties. So if you remember, when you have solved sums, whenever you have accounted for purchase of investment, you have added to that whatever brokerage fees or taxes you have paid, that will be added to your cost. Second, or you may say additional point, if an investment is acquired or partly acquired by issue of shares or other securities, then the acquisition cost is the fair value of the securities issued or given up. So let us say you are acquiring 100 equity shares of another company, and in exchange of that you are giving your 200 preference shares. Now when you are giving your own 200 preference shares for that, what is the fair value of those 200 preference shares? Let us say it is 2 lakh rupees. Then 2 lakhs will become your cost of acquisition of those 100 shares of another company. So fair value of shares, assets given or securities given, will become the cost of securities received. The fair value may not necessarily be equal to the nominal or par value. So don't take only nominal or par value, take the real fair value. Let us say those preference shares which I am giving in earlier example, 200 preference shares, its face value is only 20, let us say 1 lakh rupees. But the fair value is 2 lakhs. Then I have to consider 2 lakh rupees as the cost of new shares what I am getting. Next point, if an investment is acquired in exchange or part exchange for another asset. Let us say I am getting 500 equity shares of another company in exchange of a machinery. Now in that case, what should be the value of shares what I have got? Now the value of those shares held as investment will be fair value of asset given or fair value of shares received, whatever is easily ascertainable. So what is easily ascertainable? Either of these two. that will be treated as the cost of those shares what I am getting. Now what are these two things? Fair value of shares received or fair value of machinery given. Let us find out the values of this. What is easily ascertainable? Let us say easily ascertainable is fair value of machinery given. Then that will become cost of shares. Or if what is easily ascertainable is fair value of shares received, then that will become my cost of shares. So I'll read it one more time. If an investment is acquired in exchange or part exchange for another asset, the acquisition cost of the investment is determined by reference to the fair value of asset given up, that is machinery in our example, or the fair value of investment acquired, in our example shares received, whichever is more clearly evident, which is very simple, I suppose. Let us now go to point number C, D and E, which you have already studied, C and D, in your investment sums. Now whatever investment you have acquired, interest, dividend or rent income, whatever you are going to receive, normally is your income and will go to P&L. It's a very clear terminology. But when you acquire certain, let us say securities, investments, come interest, then later on, to that extent, interest pertaining to the period prior to the date on which you have acquired it will be reduced from your cost of investments, which you have already done. So please always remember, your investments made in securities for which you are getting interest income pertaining to the period prior to the date of your acquisition will always go on to reduce from your cost of investment. On a very same line, if you have acquired shares, now any dividend received for pre-acquisition period, then that much dividend ideally should be reduced from your cost of shares. And after post-acquisition, whatever dividend you have received for that period will go to your P&L account. Now on a very same line, right shares acquired. So when you acquire a right shares at a concessional price, you are yourself buying it, you are not renouncing it, then whatever right shares you are purchasing will be added to the cost of original shares and there will be average price. But if you are renouncing the right and getting money for that, that will ideally go to P&L. But if your X price is somewhat significant less than cum price, then renouncing of shares amount will go on to reduce your shares cost and not transferred to P&L. I am quickly going through this because this is properly understood through sums which we have already solved. Now moving to next point, the carrying amount. I think I have very clearly explained to you the carrying amount concept. The carrying amount of current investments will be at cost or fair value, whichever is lower. Now if your fair value is less than cost, that amount will go to P&L as your expenditure, and later on if your fair value increases, it can go up to the cost and that amount will again go to P&L as your income. Now long-term investments we have already covered, it will be valued at cost, but if there is a permanent loss, then that permanent loss will be charged to P&L, and if tomorrow that permanent loss is recovered, then again it will be added to the cost of investment and it will be transferred as your income, but it cannot go beyond your cost, original cost. Moving to next point, point number 12, which I think we have already explained it to you. If you are holding investment in the nature of property, let us say you are buying a land or a building as a investment, now the recognition of such investment is not covered by As13, it will be covered by As10. Or if it is your stock in trade, then it will be covered by As2, but it will not be covered by As13. Now sometimes you might acquire shares of a cooperative society or a company whereby you get an exclusive right for a building. Many a times certain buildings are registered as a society, so when you want to buy a flat in that building, you don't buy actually a flat, but you buy shares of that cooperative society and you are entitled to use that flat. Now the cost of shares of that society is as good as value of flat. So let us say you have acquired the shares of that cooperative society for 50 lakhs and you get an exclusive right to use a particular flat. Now the value you have paid for buying that shares will not be again covered by As13, because actually what you are buying is a flat immovable property and it will go again as per As10. 13th point, very simple. 13th point, when you dispose of investment, whatever is the difference, carrying amount and sale amount, whatever is the difference, gain or loss, that will go to your P&L as your income or expenditure. Now when you are disposing only part of the investment, then to arrive at the profitability you have to go by average method. Take your cost as average. Let us say I bought 100 shares and I am selling only 50 shares. Then I have to take average cost of 50 shares against the selling amount of 50 shares. Whatever profit or loss that arises, that will go to my P&L account. Moving to next point, and that is reclassification of investment. Now that is possible. Let us say when I bought a share, my intention was not to hold for more than 12 months. So I classified it as current investment. So for first year I classified it as current investment. But for second year, now my intention is very clear that I am going to hold it for a very long period. So I have to reclassify it as long-term asset. Possible? So now from current investment I am reclassifying it as long-term. Or it might be exactly opposite. When I bought a share, my intention was to hold for a very long period, so it was a long-term investment. But after first balance sheet date, now I am thinking no, I will sell it immediately within a very few span of days. So now the asset has to be reclassified as current. So there will be always a possibility that you will reclassify your investment from your current investment to long term or from long term to current. When you are doing so, obviously the carrying amount principle is different for two things. I'll just repeat it. For current, the carrying amount should be at cost or fair value, which is lower, and for long term it has to be at your cost. Now when you are reclassifying it, what you need to do, let us try to understand through this accounting standard. So where long term investments are reclassified as current investments, so earlier it was long term, now you are taking it as current. Transfers are made at lower of cost and carrying amount. Don't take fair value, cost and carrying amount at the date of transfer. So when you are transferring it, whatever is the carrying amount and whatever is the actual cost, ये दोनों में whatever is less, at that you will record your current investment when you are transferring from long term to current. And next, second one, where investments are reclassified from current to long term. So now you are going from current to long term investments. Then transfers are made at lower of cost and fair value at the date of transfer. So when you are transferring it, on that date what is cost and what is the fair value, दोनों में जो lower होगा, that lower amount will be treated as cost of that long term investment now. So I hope it is very clear. I will repeat one more time. When there is a reclassification, let us say reclassification is from long term to current. Now these current investments will be taken at what amount? Cost or carrying amount, whichever is lower. Now when there is a reclassification from current to long term, then these long term investments now will be carried at cost or fair value, whichever is lower at the date of conversion. So I hope everyone understood this. Now moving to the last part, I'll say not at all relevant, that very relevant for your accounting standard questions, disclosures. So this is more of a computing section or more of a calculative standard. Disclosures, I'll quickly go through it. I have to just read it, what all disclosures it is expected from As13. The following disclosures in financial statements in relation to investments are appropriate. Now these are appropriate. That is, you may vary it, you may add or you may reduce as per your requirement. The first one, the accounting policies followed for valuation of investment. What accounting policy you are doing? That is, you may say current investments are held at cost or NRV, whichever is low, cost or fair value, whichever is lower, and your long-term investments are valued at cost. The amounts included in profit and loss statement for, so various amount that has gone to P&L, like interest, dividend received, or sale of investments, or provision for losses, or permanent loss of long-term investments. All this, whatever has gone to P&L has to be disclosed separately in P&L account. And I hope you remember AS5. We have understood. Now such items should be disclosed separately in your P&L account. There should be a separate identification. C point, significant restrictions on the right of ownership, realizability of investments, or the remittance of income and proceeds of disposal. Now let us say you have acquired certain investments, but there is a restriction on these investments. You are not allowed to sell certain investments, or you are not allowed to sell this investment to certain persons. If there are certain restrictions placed, you have to specifically mention it. Or let us say you are not able to sell it for next 6 months, or let us say they are lying in foreign country which you cannot trade now. So such restrictions should be clearly mentioned in your financial statements. The aggregate amount of quoted and unquoted investment giving the aggregate market value of quoted investments. So you have to bifurcate your investments later on into quoted and unquoted. Quoted means on listed on stock market, and where if it is a quoted, then you have to also give the fair market value of those quoted investments in your financial statements. Other disclosures as specifically required by relevant statute. So if any statutory requirement is there, those disclosures should also be made. So I hope you have understood this AS very properly. Let us quickly revise important points. So AS13 talks about investment. Stock in trade is not covered. There are so many exceptions, like leases will not be covered. Immovable property will be covered by AS10. So you have to keep that in mind. Then your investment should be classified basically into two categories, current and long term. If you have to take it as current, there are two conditions: it is easily realizable, and second, your period intention to hold should not be more than 12 months. Intention, not actual. Intention is not more than 12 months. If you are not fulfilling these two, that will be treated as long term. Now the carrying amount of current should be at cost or fair value, whichever is lower, and the carrying amount of long term will be always at cost. Now when you are talking about current, cost or fair value, whichever is lower, so if your fair value is lower, then you have to transfer that loss to P&L, and later on if fair value increases, you have to treat it as your income, but it cannot go beyond cost. For long term, I have said it has to be compulsory at cost, but if there is a permanent loss, then that loss has to be transferred to P&L account, and if tomorrow that loss, permanent loss, has gone, then again you can increase the value only up to the extent of cost, and that will go to your P&L as your income. While taking cost, all your duties and taxes should be added. If you are acquiring shares in exchange of another security, then whatever other security you are giving, the fair value of that security will become cost of your security acquired. Where you are acquiring any security in exchange of other assets, then the value of security acquired will be fair value of securities taken or assets given, whichever is more ascertainable. All your interest, dividend, royalty, rent income should be transferred to P&L. But if it is pre-acquisition, or let us say it is come interest and interest pertaining to prior to the period of acquisition, will always go on to reduce from your cost. You have to keep that in mind. Now if there is a reclassification, let us say that is from long term to current or current to long term. So if it is from long term to current, then your amount will be taken at cost or carrying amount, whichever is lower, and if it is from current to long term, then it has to be cost or fair value, whichever is lower. On disposal of investments, whatever gain or loss arising will go to P&L as your income or expenditure. So I hope we are done with this AS. Now let us quickly go through all your illustrations. Illustration number 1. An unquoted long-term investment is carried in the books of at a cost of rupees 2 lakhs. The published accounts of the unlisted company received in May 2017 showed that the company was incurring cash losses with declining market share, and the long-term investment may not fetch more than 20,000. So can I say there is a permanent loss? First of all, it's a long-term investment, so I have to carry at cost. So I will carry at 2 lakhs only. But now there is a permanent loss because they are saying it cannot get more than 20,000. So there is a permanent loss of 1,80,000. How will you deal with this? Preparing the financial statements of R Limited for the year ended 31st March 17. Now May 17 report is saying so. You have to prepare it for 31st March 17. So your answer will depend upon two things. One AS13 and another AS4. Events occurring after balance sheet date. So conditions, if prevalent, adjusting event, I hope you remember. So if conditions were prevalent there as on 31st March and later on further evidence you got, then you have to take effect of that. And I'll say it's an adjusting event, and therefore 1,80,000 there is a permanent loss in long-term investment, and I'll debit it to my P&L account, and my investment will be now carried at 20,000 only as a long-term investment. Illustration number 2. X Limited on 1117 had made an investment of 600 lakhs in the equity shares of Y Limited, of which 50% is made in long-term category and the rest as temporary investment. So I can say current. So 50% long-term, 50% current. 300 lakhs, 300 lakhs. Long-term I'll take it at cost. Current I'll take cost of fair value, which is lower. The realizable value of all such investment, all together, on 31st March 17 become rupees 200 lakhs. As Y Limited lost a case of copyright. From the given market conditions, it is apparent that the reduction in the value is not temporary in nature. So there is a permanent loss. So even for long term, you have to book a loss. How will you recognize the reduction in financial statements for year ended 31st March 17? Okay, let us answer it in two parts. First, long term. So long term cost is 300 lakhs, but there is a permanent loss of 200 lakhs because the value now you can get is not more than 100 lakhs. So 300 lakhs cost, I have to take it at cost, but there is a permanent loss of 200 lakhs. So I have to debit it to P&L account, and my carrying amount will be only 100 lakhs. Now second part, current investment. Current investment cost is 300 lakhs and fair value is 100 lakhs. And I have to take whichever is lower. So lower is 100 lakhs. I'll take 100 lakhs and 200 provision will be debited to P&L account as my expenditure. So total to P&L will go 400 lakhs. 200 lakhs for permanent loss and 200 lakhs provision for taking at fair value for current investments. And now in my investments, long-term investments will be shown at 100 lakhs and current investments will also be shown at 100 lakhs. Next, question number 3. Messrs Innovative Garments Manufacturing Company Limited invested in the shares of another company on 1st October 16 at a cost of rupees 2,50,000. So shares of another company taken at 2,50,000. It also earlier purchased gold of rupees 4 lakh and silver of rupees 2 lakhs on 1st March 14. So there are three investments: shares, gold and silver. Market value is on 31st March 17. So they have given you market value. You can say it is a fair value. Shares 2,25,000. So there is a reduction. Gold, there is an increase. And silver, there is again an increase. From 4 lakh gold has increased to 6 lakhs. And from 2 lakh silver has increased to 3,50,000. How above investments will be shown in the books of accounts of Messrs Innovative Garments Manufacturing Company Limited for the year ending 31st March as per the provisions of As13 accounting for investments. Let us talk about first shares only. Now shares, they have not said whether it is current or long term. So we have to give answer for both. If I treat it as current investment, then I have to take cost or fair value which is lower, which is 2,25,000. So I'll take it at 2,25,000 and I'll provide a loss of 25,000 in my P&L account. Very clear? Now if I treat my shares as long term, then I have to take it at cost and the cost is 2,50,000. Now there is no case of permanent loss here, so there is no need to write it off that permanent loss. I'll take directly at 2,50,000. Now for gold and silver, normally it is always presumed it is long term, so it has to be at cost only. So it's 6 lakh and 3,50,000. Now even if I treat it as current, my fair value is more than cost, so I have to still take it at cost, but it is ideally to treat gold and silver always as long term. So if I'm treating it as long term, it will be at cost 6 lakhs and 3,50,000 respectively. Clear? Let us go to last one, fourth one. ABC Limited wants to reclassify. So it's reclassification. Its investment in accordance with As13. Decide and state on the amount of transfer based on the following information. A portion of current investment purchased for 20 lakhs to be reclassified as long term. Do you remember? We have discussed. So from current to long term, you have to take it at cost or fair value which is lower. So cost is 20 lakhs. As decided, as the company has decided to retain them, the market value on the date of balance sheet is 25 lakhs. So very clear. Cost or fair value which is lower. So what is lower? 20 lakhs. So now it will be shown as long-term investment at 20 lakhs. B. Another portion of current investment purchased for 15 lakhs to be classified as long-term. So when you're going from current to long-term, again same, you have to take at cost or fair value which is lower. The market value of this investment as on the date of balance sheet was 6.5 lakhs. So cost 15 lakhs, fair value 6.5. What is less? 6.5. I'll take it at 6.5. And actually it is a C part. C. Certain long-term investments no longer considered for holding purposes to be reclassified as current investments. So now you're going from long-term to current. So you have to take cost or carrying amount whichever is lower. The original cost of these was 18 lakhs but had been written down to 12 lakhs. So there is a carrying amount of 12 lakhs to recognize other than temporary decline. So cost 18 lakhs, carrying amount 12 lakhs. I'll treat it at 12 lakhs as my current investments. So I hope everyone have understood this very properly. So we are done with As13. Thank you.